Do you think data dependent has more to do with credit availability now? Same question I just posed to Leisman.
Look, I think the credit availability story is key, and Steve kind of hit the nail on the head when he said we're going to be looking at a lot of new pieces of data. That Thursday balance sheet report from the Fed is now going to become mission critical. Someone said it in the earlier hour that maybe that's the new CPI report. The more these banks are using it, the more people are going to get stressed out. That said, I would turn it on its head and say the Fed did add $300 billion of reserves back into the system. It did quantitative easing by every measure of what that is, or balance sheet expansion. You can parse it up and say it was not traditional purchasing of securities and the like, but the bottom line is the reserves were added and the securities were taken out. And that is a big deal, and that may continue to be a big deal. And we could find out that that's up another 200 or 300 billion. And net, that is an easing, not a tightening, and it offsets a lot of the credit tightening that we're worried about that comes from the banking stress in the regionals.
And the volume's really low. It was down, but now it's flat again.
Yeah.
I would have bought that all day from you, down 4%. But,
for a second, it was.
Can give it a shot.
All right, I want to keep tugging on this thread, Nancy. I want to get your thoughts on this very topic too, which you brought up before we went to Steve Leisman, and that is the fact that quantitative tightening, or at least technically as it has existed, has not changed per Powell today. But we did have this expansion of the balance sheet. What does it mean for all of the volatility we've seen in fixed income and specifically in the bond market in recent weeks, and how does that continue to, I guess, manifest and materialize there now?
Well, I think it's a tremendous opportunity for investors to add inflation-linked securities to their portfolio, because the balance sheet, whether they want to call it QE or not, the balance sheet is expanding. The Fed has eased off their path right now of rate hikes, and inflation is priced in the future way below the 6% last CPI print. Just the 5-year inflation expectations is right around 2.2%. So I think it's time to stand on the soapbox and say, look, we hope the Fed's got this, but I didn't have a lot of confidence in the Fed when Powell said that he was surprised to hear about Silicon Valley Bank and how did that happen? I was thinking to myself, what is he talking about? It's mortgages. It's always what blows up every single market, is always short volatility. It's always the same. It's just in the bond market. It's in the vol markets. It's in these mortgage books. A third of the ag is mortgages. So I think it's a huge opportunity for people to wake up and realize that the ag has no inflation protected bonds whatsoever, and a third of it is short volatility from the mortgages. So it's really important to be diversified. Don't go by name only. And it's a great opportunity to buy future inflation expectations because they're right around the Fed's 2% target.
Yeah, you're saying, Nancy, to add inflation-linked assets here. What do you have in mind when you say that?
Well, so we own, I'm the portfolio manager for the quadratic interest rate volatility and inflation hedge ETF. About 80% of our fund is a type of U.S. Treasury bond called TIPS, which are Treasury inflation protected securities. And then we add interest rate options to fix the issues that exist with TIPS, which is mainly what Powell talked about, that a third of CPI is linked to rent, and it's very much a lagging indicator. So we add inflation expectations outside of CPI to the portfolio. And I think it's a really great time for investors to be looking at diversifying assets like that, because inflation expectations in the future are trading at a huge spread to where realized are.